Hi and good day. Before we go on to our presentation, let me introduce to you our group members. So, I am K.Hevin with ID of AC01025888. So, next will be
I'm Shani Sankar with ID AC01022299.
My name is K.Hevin Kumar and my ID number is AC0103242. My next group member is
Okay, my name is Shivraj Anaraki Sunkaraj. My ID number is AC0103085. Okay, that's all for now.
okay. I'm going to present about the rise and fall of management accounting and about the introduction. Okay, management accounting reports help to operating manager to reduce cost and improve productivity. And then reports decrease productivity because they require operating manager to spend more time on trying to understand and explain reported variances. Okay, then management accounting system never provide timely and detailed information on process or focus too narrowly on inputs. The examples was direct labor. They related uh, to today's production environment. Okay. Then the system also distract managers from noticing the key factors important for production efficiencies. Management accounting system fails to provide accurate product cost distributed to products by simplistic measures, usually direct labor based, that not represent demands of each product or firm's resources. Okay. While simplistic and aggregate product costing method are enough for financial reporting requirement, the methods yield value for inventory and for cost of goods that satisfy external reporting and audit requirements. Standard product cost system. The information represent only available data on product costs. A dangerous opportunity exists for misguided decision on product pricing, product sourcing, product mix, and response to rival product. Many firms to be falling victim to this system or traffic. Other than that, managers horizon contract to short-term cycle of their monthly profit and loss statement. Short-term profit pressures and lead to a decrease in investment for long run. Monthly accounting statement using practices mentored for external reporting can signal increased profit even when the long-term economy health of the firm has been compromised. And then there could be many very short-term measures that will be appropriate for motivating and evaluating manager performance. Okay. Today's management accounting system provide a misleading target for manager attention. They fail to provide relevant set of measures that appropriately reflect the technology, product process, and competitive environment in which the organization operates. Originally designed earlier in this century to help coordinate the diverse activities of emerging vertically integrated and enterprises. Okay, so thank you.
Good morning to Madam Faiza. So today I will be talking about the challenges that accountants face in preparing the management accounts reports. So some of the challenges that they faced were vigorous global competition, rapid progress in product and process technology, and wide fluctuations in currency exchange rates. So another challenge that they faced during the birth of management accounting was to provide timely and accurate information to enable cost control efforts and to improve the productivity of the organizations. And these reports are very vital because it was important to report accurate product costs so that pricing decisions can be done easily. Okay. Not only that, reporting of accurate product costs will enable the introduction of new products and abandonments of obsolete products. So this is done so that the products which are not useful or not gaining profit can be written off, or we can say that get rid of. Okay. So next, the organization's management accounting system functions as a two-way communication link, whereby the senior management, they use this communication link to disperse and spread the goals and objectives of the organization to the subordinate management. However, the subordinate managers use this communication link to disperse information to the top management regarding the performance and comments of the products that they have invented. Okay, so the success of an organization management of the organization's management accounting system depends on the products that the customer needs. Okay, so however, not only that, the success of an organization's management accounting system depends heavily on the products, whether they meet the customer needs or not. Okay, not only that, the success of an organization's management accounting system depends on the marketing efforts and also the efficiency in the production procedure. So that's all for the challenges that the accountants faced in preparing the management accounts. Okay, so now we will move on to the next point, which is the opportunities in this topic. Thank you.
Is faced by accountants in the rise and fall of management accounting is the increased demand for excellent management accounting system occurs when the cost collecting, processing, analyzing and reporting have increased. In highly accommodated environment, virtually every transaction can be captured. Timely and relevant managerial performance measures can be computed throughout the organization. Today's designers of management accounting system can be used suffocatingly electronic technology to devise reporting and control systems that are more accurate, more timely and more effectively.
So now I will be presenting about management accounting rules. Okay. As we all know, the presence of accounting reports and methods has been long recognized. It can be said nearly 500 years ago, it has been found by Fra Pecchioli and another Italian called Luca Pecchioli. However, presence of management accounting and info about transactions that happens within an organization has been much more a recent phenomenon. As a consequences of industrial revolution and ability to achieve gain through economies of scale, it became efficient for enterprises owners in the 19th century to commit sums of capital to their production process. Successfully managed organization revealed that gains could be earned by managing a hierarchical organization. An example of those successful organizations are textile mills, railroad companies, and steel companies. So, early management accounting measures seems well and simple, but was adequate enough to serve the needs of owners and managers. The objective of this process was to identify the costs for the intermediate and final products of the firm, to provide a benchmark, and to measure the efficiency of the conversion process. So by the mid of 19th century, great advancement in transportation and communication with the invention of railroad and telegraph. Okay. These provided opportunities for larger gains for organizations. However, effective management accounting systems were necessary to coordinate the logistical, conversion and distribution activities for these enterprises. Okay. During the mid of 19th century, the largest enterprise ever was the Railroad Corporation. Okay. To oversee their diverse and dispersed operations, new procedures were invented. Okay. Management accounting back in the 19th century were designed to motivate and evaluate the efficiency of internal process. Not only that, management accounting was created to promote efficiency in the key operating activity of the organization. One of the most important management accounting innovation was the return on investment, or also called the ROI. So this measure provided an overall measure of the commercial success of each operating unit and of the entire organization. Okay. The use of ROI, which is also known as return on investment, was vital to top managers to direct their allocation of capital and evaluate performance of the organization. Okay. The ROI measure, which is the return on investment measure, can be derived to two, which is the operating ratio and also the stock turn. So that is all for management accounting rules. So we will now go to the next point.
I'm going to talk about the lost relevance in the rise and fall of management accounting. By 1925, virtually all management accounting practices that are practiced today had been developed. These practices has evolved to serve the information and control needs of the managers of increasingly complex and diverse organizations. But the pace of innovation seemed to stop in the mid 1920s. Perhaps there was little incentive to continue to develop innovative management accounting procedures because the corporate organization form developed by companies such as DuPont and General Motors proved to be the model for many corporations for the next half century. However, the diversity of product and complexity of manufacturing process continued to increase in the decades after 1920s. Thus, the need for accurate product cost and effective process control should have imposed new demands on organization management accounting system. Yet, the evolution of management accounting system after 1920 did not keep pace with the improvement in corporation product and process technology. These lags eventually led to today's problem. In part, this stagnation can be attributed to the dominance of the external or financial accounting system during the 20th century, with some widespread public ownership of corporations, security, the demand for periodic audited financial statement increased. Auditor, mindful of potential liability to use of financial statement, preferred conservative accounting practices based on objective, verifiable, and realizable financial transaction. When measuring cost of goods sold and valuing inventory, auditor insisted on product cost based on the historical transaction recorded in the firm's ledger account. In principle, early 20th century managers did not have the yield to design of the cost accounting system to their financial accountants and auditors. Over the years, as corporation product lines expanded and production technology changed, left unquestioned was whether the system was still sustainable given the great expansion in information technology represented by electronic and digital computers.
Now I'll present about academies led astray. We believe academies were led astray by focusing too narrowly on simplified model of firm behavior. 60 years of literature emerged advocating the separation of costs into fixed and variable components for making good product decision and for controlling costs. As management accounting system became less relevant and less representative of the organization's operation and strategy, many companies became dominated by senior executives.
I am going to present about the accounting for caravans. The cost of caravan and cost of acquire the initial load of merchandise from revenue received from sale of tea in Italy to compute a profit for the entire trip, the profit to be distributed among investors in the venture. Okay. The role of accountant to compute overall profitability of the venture and distribute net proceeds among initial investors. Okay. SEC and or FASB ask accountant to compute the expenditures profit during third quarters of 484. It means 484. Okay, when caravan traversing the person desert en route to India. Okay, that allocating the total profit of expedition to periods as short as 3 months was not meaningful exercise. Yet isn't the value of preparing monthly income statement for many of today's organizations, not unlike an attempt to allocate the profits of a long venture to every month within that venture. Okay. Arguing that it is meaningless to allocate project profitability to short time periods within the life of project does not imply that we believe it fruitless to attempt to obtain valuable indicators of short-term progress. Okay, returning to our Venetian expedition, there probably are many measures of mm, the caravan's performance during the third quarters of 1487 that the investor will be interested in knowing. For example, what distance did the caravan cover and in what direction, how many provisions are left, and what is the condition of the cotton of rebellious. Okay, there are many potential useful indicators of the caravan manager's performance during the third quarter 1487, but quarterly profits is not one of them. And given the current competitive technological environment, there are probably many better indicators of a company's short-term performance than its quarterly earnings. Certainly, cash flow is important and we will want to know the pattern and structure of a company's cash receipt and cash expenditures. But knowing sources and uses of cash is very different from working hard every month and every quarter to produce complete income statement and balance sheets. Recomplete with amortization, capitalizations, and many other accruals. Okay, thank you.
Now I'm going to talk about the needed innovation in the rise and fall of management accounting. The challenge and opportunity for contemporary organization is clear. Management accounting system can and should be designed to support the operation and the strategy of the organization. The technology exists to implement systems radically different from those being used today. What is lacking is knowledge, but this knowledge can emerge from experimentation and communication. The innovative spirit of 100 years ago at the outset of the scientific management movement can be recaptured by creative managers and academic researchers who are committed to developing the new concept for designing relevant management accounting system. Thank you.